Most investors today believe the tech bubble began in the late 1990s with dot-com startups, garage founders, and newly minted millionaires. But that assumption hides a secret. Nearly 2 decades earlier, long before anyone typed .com, Wall Street had already lived through a high-tech mania so intense, so irrational, and so misunderstood that its collapse nearly rewired the entire United States financial system. The real first tech bubble wasn't the dot-com crash. It was the 1980s stock market frenzy, a moment when new inventions dazzled investors, computers promised a frictionless future, and a generation of traders convinced themselves they had discovered a formula for endless growth. But what truly happened? And why did everyone believe technology alone could defy gravity? Because beneath the excitement, beneath the microchips, the satellites, the new computer companies, something darker was happening. And the answer explains not just the 1980s bubble, but every financial mania since. To understand why the bubble formed, you have to travel back to an unlikely starting point: the economic stagnation of the 1970s. America was exhausted. Inflation was suffocating the middle class. Interest rates were sky high. Unemployment was stubborn, and the stock market had gone essentially nowhere for nearly a decade. Investors were hungry, desperate for a new story, something that could restore faith in the future. And just when the system seemed unable to break free from malaise, a new wave of technologies appeared, each one promising to reshape the world. Personal computers, microprocessors, satellite communications, early biotechnology, digital financial tools, all of it arriving at once, like sparks landing on dry forest floor. Young entrepreneurs were founding companies with visionary ideas but almost no revenue. Engineers who once worked for NASA or Cold War defense labs were spinning their knowledge into commercial tech firms. The media celebrated these creators as modern pioneers, and at the center of this technological awakening was Wall Street, eager, restless, and more willing than ever to turn hope into valuation. But hope alone doesn't create a bubble. Something else must ignite it. And in the early 1980s, one man lit the match: Federal Reserve Chairman Paul Volcker. When Volcker raised interest rates to crush inflation, a painful but necessary policy, the economy initially plunged into recession. But once inflation finally collapsed, interest rates began to fall. Suddenly, capital was cheap again, and investors who had spent the 1970s clinging to cash now flooded back into stocks. They didn't just want stability. They wanted explosive upside. They wanted the future. They wanted technology. By 1982, the bull market was roaring. New computer companies were going public at a speed the market had never witnessed. Firms that had barely manufactured a single product were being valued like global giants. Wall Street analysts, many of them young and inexperienced, began relying on forward-looking projections that assumed constant exponential growth. If a company grew 20% one quarter, some analysts predicted it would grow 20% every quarter forever. And because the technology was new and poorly understood, few investors questioned the models. But something else supercharged the mania: computers themselves. For the first time, Wall Street was using electronic trading platforms, data terminals, and quantitative strategies that relied on early algorithms. Portfolio insurance, a computerized technique designed to limit losses, became wildly popular. The idea was seductive. Computers, not humans, would protect investors from crashes. Technology wouldn't just make profits, it would eliminate risk entirely. Every bubble has a moment when imagination overwhelms reality. For the 1980s tech bubble, that moment came when high-tech companies started attracting price-to-earnings ratios so absurd that even veteran investors were stunned. Newly listed firms had PE ratios of 80-100, even 150. Some had no earnings at all, but that didn't matter. As long as the story was good, as long as the technology sounded revolutionary, investors kept buying. And still, the true breaking point hadn't arrived, because the most dangerous phase of any bubble is not when stocks rise, but when the system convinces itself that a crash is impossible. Through the mid-1980s, the market kept soaring. The bull market became a cultural force. Wall Street was glamorous, traders were celebrities, and the emerging tech sector became a playground for speculation. The belief that this time is different spread like wildfire. Yet beneath the surface, structural faults were beginning to form. Portfolio insurance created a false sense of security. If prices fell, computers would automatically sell to protect portfolios. But that very mechanism guaranteed that if selling ever began, the computers would amplify, not prevent the panic. Specialists on the trading floors were overwhelmed by the volume of automated orders. Liquidity was thinning, and corporate America was using debt-fueled buyouts to boost stock prices artificially. The system was becoming more fragile each month, but the rising market made everyone blind to the danger. Then, in 1987, came the spark no one expected. It didn't start with a recession, a war, or a major corporate scandal. Instead, it began with something far more ordinary: rising interest rates and fears of trade imbalances. Concern turned into caution, caution turned into selling, and selling triggered the computer-driven portfolio insurance strategies. On October 19, 1987, a day now known as Black Monday, the market fell by more than 22% in a single day. To this day, it is the largest one-day percentage decline in United States stock market history. The crash was brutal, fast, and shocking. High-tech stocks, the very companies investors believed would never fail, were among the hardest hit. Some fell 40%, 50%, even 60% within hours. A generation that believed computers would stabilize markets learned the opposite. The technology magnified the panic instead. Investors stared at the screens in disbelief. Analysts who had once promoted futuristic growth models now scrambled to explain why those companies had been so fragile. And high-tech firms that had enjoyed almost unlimited access to investor cash suddenly faced a funding winter. But the most unsettling part of the crash wasn't the drop itself, it was the aftermath. Because even after the dust settled, the economy didn't collapse. Unemployment didn't spike. Banks didn't fail en masse. The financial system, despite the historic decline, survived. And that created a dangerous lesson: the belief that bubbles could pop without consequences. If investors learned that markets always bounce back, they might become even more reckless. And that's exactly what happened. After Black Monday, the Federal Reserve quickly stepped in to reassure markets, providing liquidity and signaling support for the financial system. It worked perhaps too well. Investors took the intervention as proof that the Fed would always rescue markets. The 1980s tech bubble did burst, but it did not destroy the system. Instead, it conditioned investors to expect central banks to cushion every fall. High-tech companies recovered, but they recovered in a different world. Venture capital emerged as a more powerful force. Silicon Valley transformed from a cluster of engineering labs into a cultural icon. Wall Street, newly equipped with digital trading tools, became addicted to speed, data, and short-term momentum. The groundwork for the 1990s dot-com bubble, the next great tech mania, was being laid in real time. But the story doesn't end with the recovery. Because the long-term impact of the 1980s bubble was deeper than any single crash, it reshaped how investors think about technology, risk, and the future. It normalized speculative valuations for high-tech firms. It expanded the belief that innovation alone could justify any price. It encouraged central banks to intervene during market turmoil. And it embedded computer-driven trading into the DNA of global finance. And the most surprising part? The patterns of the 1980s bubble have repeated themselves again and again, almost like a financial echo. Look at the dot-com crash of the late 1990s. Soaring valuations, inexperienced analysts, futuristic promises, and companies with no earnings. The same story. Look at the housing bubble of the 2000s. Complex financial engineering, misplaced faith in risk models, and investors convinced that the market had fundamentally changed. The same story. Look at the crypto boom. Revolutionary technology, meteoric valuations, and a belief that old financial rules no longer apply. Again, the same story. And today, the parallels are even sharper. Artificial intelligence stocks soaring on hype. Electric vehicle manufacturers valued like established giants. Story stocks rising on narratives instead of cash flow. Algorithmic trading systems controlling more than half of all market volume. Central banks providing support at the first sign of instability. And once again, investors telling themselves, this time is different. But history says the same thing every time. Nothing grows forever. Technology can transform industries, but it cannot eliminate economic cycles. Models can predict trends, but they cannot prevent panic. And markets may evolve, but human psychology does not. If the 1980s bubble teaches anything, it's that innovation attracts excitement, and excitement attracts excess. The faster the technology changes, the more likely investors are to imagine a future unconstrained by reality. And the more they imagine, the more they inflate prices beyond what companies can deliver. Yet the solution is not pessimism, it is understanding. Because bubbles are not accidents, they are processes. They form when optimism turns into speculation, and speculation turns into belief that risk no longer exists. They burst when reality catches up. And the story of the 1980s tech bubble offers 3 clear lessons for today's markets. First, every technological revolution creates winners, but the winners are rarely the early hype-driven companies. Second, any system that claims to eliminate risk is usually hiding the very thing that will trigger the next collapse. And third, the most dangerous belief in finance is that central banks will always save the market. Intervention can delay consequences, but it cannot erase them. So the next time you see a stock soaring, not because of profits, but because of promises, remember this. Wall Street has seen this movie before, in the 1980s, in the 1990s, in the 2000s. The actors change, the technology changes, but the plot does not. If you found this story insightful, consider subscribing to the channel. It helps more people discover the hidden history behind today's markets. And stay tuned because the next financial bubble is already forming, and the lessons of the past may be the only guide we have to understanding the future.